When it comes to tax loss harvesting, most CPAs are going to give you the exact same tips. Today, I'm going to give you 3 secret tax loss harvesting tips that many won't share with you. In the midst of the prevailing bear market, these insights could be game changers for your tax strategy. First, tax loss harvesting is a method employed by investors to minimize their capital gains taxes. This technique involves selling an asset that has experienced a loss, thereby using that loss to offset other capital gains. For cryptocurrency investors, this can be a valuable strategy. Before diving into our first strategy, it's crucial to differentiate between 2 kinds of losses. Unrealized losses, which refers to the decline in value of an investment, but this loss only exists on paper, since the asset hasn't been sold. Realized loss. This is the loss confirmed by selling an asset at a price lower than its purchase price. In the world of taxes, only realized losses can be claimed to offset gains. Let's dive into the first secret strategy, strategic selling. Imagine you buy Bitcoin. Unlike stocks where each share is the same, Bitcoin purchases can be thought of as separate lots. If you buy Bitcoin multiple times, each purchase represents a distinct lot with its own cost basis. Imagine you bought Bitcoin on 3 separate occasions. Lot A was purchased at $10, Lot B purchased at $7, and Lot C purchased at $11. Now, the total cost basis on all 3 of these lots is $28. And let's say the current market value of Bitcoin has fallen to $9. If you were to sell all of your Bitcoin, your realized loss would be based on the difference between the total cost basis, $28, and the current value multiplied by the number of Bitcoins you hold. However, by being strategic and employing lot-specific identification, you could optimize this. By realizing a bigger loss, you can offset more capital gains from other investments, potentially reducing your tax liability. This is especially useful in years where you might have significant gains from other assets. Now, for the second secret, timing your sales. In the world of investments and capital gains tax, timing is everything. Capital gains taxes are levied on the profits made from the sale of an investment, and the rate that these gains are taxed can vary significantly based on how long the investment was held. There are 2 primary categories for capital gains. Short-term capital gains, which are realized from the sale of an asset held for 1 year or less, and short-term gains are typically taxed at your ordinary income rate, which can be higher than the long-term tax rate. Long-term capital gains. These arise from assets that are held for more than 1 year, and they benefit from a preferential tax rate, which is often lower than the short-term tax rates and can lead to a significant tax savings. If your investments are sitting in long-term gains, meaning they have appreciated in value and have been held for over a year, consider selling them to lock in the gains and take a tax advantage of the lower tax rate. Conversely, if your assets have not yet reached the 1-year mark but have appreciated, you might want to wait until they qualify for the long-term rate before selling. When you own multiple positions or lots of a particular asset, like a cryptocurrency token, consider which specific lot to sell based on their acquisition date and cost basis. And by being selective about which tokens or shares you sell, you can optimize your tax outcome. In essence, strategic tax management boils down to timing. Finally, the last secret is diversifying your wallets. With the rise of cryptocurrency's popularity, effective management of digital assets is essential. And one of the ways to achieve this is by diversifying units. By segmenting assets based on their purpose and time horizon, you can simplify tracking, enhance security, and ensure efficient usage. Why diversify your wallets? Well, distributing your holdings across multiple wallets can minimize risk for one. If one wallet gets compromised, not all assets are lost. But with distinct wallets, you can more easily track transactions, balance, and the purpose of each asset. Different assets might be subject to different tax treatments, especially when categorized as short-term or long-term holdings. Diversified wallets can simplify tax reporting. These are the 3 secret tax loss harvesting strategies that many people don't tell you about. Which one suits your crypto tax strategy best? Let us know in the comments below.